I love your model and the way that you guys are doing it. Of all the funds I've looked at, there are only 2 funds that I've ever come across that are doing what you're doing.
I think it's going to be more and more, to be honest with you. I think that's where, if you want to raise and make, LP happy and respect your LP, I think it's going to go that way. It's not about the 2% that is the problem, because they understand that employees, they need to have money to run the fund. What we have done with YXS Capital, every money that we receive from LP first, we return 100%. And then all the management fee that we ever receive, we return it to the LP as well.
Oh, I love that.
After our LP make 3x net, so not gross, we get an incentive. What is the incentive? After that, we're getting 30% carry. It's just showing our LP that we are there for the big commission.
Right.
And don't get me wrong, I'm here to make money, but I will make money and even more money with my LP.
What's up, Yotis? Good to have you here.
Yeah, thank you for having me.
Yeah, this is going to be a ton of fun. So we got a chance to hang. You flew in on Wednesday. We did a little happy hour at the Red Fridge Society, where I'm a member, and there's a really fun post-exit founder community, and then also tech community. My good friend Chris Taylor runs that place. You met him; he's a blast. My good friend Mario, who's our sommelier, he was pouring wine and having a good time. We had a bunch of people. Just mixing and mingling, talking about investing and venture and AI and robotics, just, deep tech. And so it was fun being able to feature you that way and really have you get exposure to a lot of the friends and family and ecosystem that I have here in Austin.
Yeah, it was really nice. I think the ecosystem, in Austin is really special. Of course, you have, SF that, is the leader, is going to continue to be the leader for the next 20, 30 years. But there is a very nice vibe in Austin, in a lot of industry, AI, VCP. So yeah, it was pretty fun.
Yeah. Well, I had a blast. It was fun hearing you teach and share all the things that you know. And then obviously, you came in for this show, and I appreciate you, making it to come in person from Miami. It was fun getting a chance to hang with you when I was out there earlier this year. So I can't wait to get into your niche of investing. And so, I mean, you're big in the venture space, but let's specifically say kind of Series A through Series D, potentially beyond, but that's kind of your sweet spot. And for those that don't understand that, elaborate a little bit, because and by the way, we'll go back in time to you as a founder and you having exits, but I just want to establish like your expertise here, being in these more mature companies. You get to a Series A, a Series B, Series C, and so on. They're getting more and more mature. Revenue is higher at each segment. The way that you allocate is different and very calculated. So talk about that a little bit.
Yeah, so globally, we are looking on the low end, a minimum of 2 million in annual recurring revenue. Depending of the industry, can change. That's on the Series A. The whole investment thesis is really on the post-product market fit. So we really need the company to already, know the customer, confirm the need, confirm everything before we look to the company. That might be an investment for us. Sometimes we find, seed company that might be a fit on the quality, but not mature enough. Of course, we have partner that invest before us on those company and then come back to us. And then we have Series B, Series C, and D. To be exact, 15% of our allocation is A, 70% is B and C, and then 15% D.
So you're basically, it's calculated like, hey, this is not a startup company. This is a mature company. And then as they continue to mature, you're rolling more capital into them to the tune of, 70 to 30, right? I mean, really, it's like, it's actually 85 to 15, right? As they mature beyond that Series A. And so I think that's important because a lot of the time people hear, investing in venture, and so many of my friends who are entrepreneurs, because they've run successful companies, they're like, oh yeah, I'm going to just throw money into my friend's company and then this company. And because I'm successful as an entrepreneur, I can spot these companies, and they end up investing in all these super early stage companies, seed, pre-seed. So that's not you. You guys are well beyond that. But even in the venture side of things, there's a huge disparity of top quartile to bottom quartile, right? You've got about a 25% return gap there from the data that I've analyzed. So, you've got people obviously that are losing money, but your lower quartile is kind of operating in the 4-ish%. Your top quartile is kind of, in the 20 to 25%. And so not all venture is the same. Not all sectors or subcategories of venture is the same. Why did you pick what you picked in venture? Kind of going deep.
Yeah, I think a couple of precision on that. I think there is a segmentation for the past, I will say, since 2021. Between pre-seed and seed, you can see there is a fund that really specialize in that, and then you have the fund that doing A, B, C, D or A, B, C. It's just about the risk as well of those different stage. I think there is also a lot of angel investor that or successful exit founder that start investing in pre-seed and seed because that's where you are the easy allocation to get,
right,
but are making a mistake on trying to play, I call that the quantity game without the quantity. So what I want to say is that when you are an angel and you start investing in 2 or 3 pre-seed and seed, you are going to hit the wall for sure. It's impossible.
Odds are against you.
It's not going to work. You
need the law of numbers, 50 to 100 bare minimum.
Yeah, of course. And I'm going to give you an example. I know. So one of our partner and advisor is Jean de la Roche-Brochard. Is the MP of Kima Ventures for the past 10 years. Biggest angel investor in Europe. They invest in 150 company a year for the past 11 years.
Wow.
Now they reinvest, so it's a 15 million, investment because it's a 150K ticket. But what is going on is that they can do that because they invest in 150 companies. So even if they lose 70% of the investment in all the companies, they are making so much, return on the 10-20% that the strategy works. And so it's just about the strategy between quantity and quality. We work on the quality game, and so that's why we go to that series B and C. That's really our sweet spot, and also because we work as a VC / PE, so we have the structure of a VC, but we have the mentality of a PE as well, and of course banker because of my 2 partners, Sunny Patel and Lauren Katsovich. But what is going on is that when you look to even of our fund 1, track records, and we can go back to that, where we were making the most return was on this, B and C companies. Even if before we invest in seed, it's just that it doesn't make sense for us now with all the deal flow we have to take the risk to invest on those companies, because again, we are going to make on our fund, we are going to make 20 more, 20 investment, and then just keep a big part of that to do the follow-on. So it's also back to the segmentation of our market now.
Yeah, and I want to dive deeper into both, into really the spaces and niches that you're in, but then also the performance on your first fund. Before I do, I just want to comment that I do a lot of research on what single family offices do and multifamily offices, and specifically for families that have net worth of 100 million or greater. I really study that data. I like to democratize that, especially on the single family office side when you kind of hit billionaire status, because the playbooks are great great playbooks, and you don't have to have $1 billion to do the same playbook. But what I notice in asset allocation is they're all in venture capital. I mean, across the board, somewhere between 4 and 10%. Some that are a little bit more aggressive, maybe they're going on up to 15%, maybe a little higher than that. But there is an asset allocation that is like it's a given. It is for sure they're going to invest in this space. You see it a lot less on the early side, right? As an angel, seed, pre-seed, it's like 1% or less than 1%. But you see a lot of these families, and for me, I like kind of being in that 10%. Even sometimes I'm, depending on, whenever we're rebalancing the portfolio, because I've done so well in venture, we're often pushing 12 or 14% for us as a family. So I love the space, but some of your numbers the first time around in your first fund are just like incredible, right? A 14.6%, gross return across the board. And this was what blows my mind, because I feel like in venture, I learned when I first started investing in this space, you're going to have a bunch of losers, but the winners are going to balance out the losers. And that's virtually what everyone says, okay? You guys are the opposite. So you had 0 losers. You invested in 14 companies.
Yes.
14 of which will have exits. I think 12 already did. 2 more are coming.
Yes. So we are at 9 already done. We have 2 positions that we still have, Canva and Mercury, that are our biggest position, but the both company are going pretty well. So we can get liquidity to that tomorrow if we want. Right. And then we have 3 others that are early stage. Might go south. Is not the case for the moment. Everything is going well, so no markdown for the moment. But even if the 3 company, not going well, we will still be at 14x DPI at the end. So doesn't matter. But yeah,
because you're just getting started with this, because a lot of these companies are still climbing. And then, by the way, out of the 14 companies, 5 of them are unicorns. So I just feel like your ability to find the deals is incredible, and you've got this high criteria of what it takes to actually get in. So let's talk about what does it take to get into, for you to actually invest, and then secondly, what categories are you guys focused on? Because you're focused in the spaces that I personally love, so it's just perfect for me. When we met, I was like, well, heck yeah, this is already where I'm investing anyway.
Yes, no, that's a great question. I think there is 2 differences between Fund 1, our Fund 1, and now our Fund 2, because, industry change and you need to play the game as well.
Yep.
So for the Fund 2, yes, it's AI, workflow, space, military tech, robotic, deep tech, and a little bit of fintech. That's where we are focused on. On the first question about how to, find a deal, I think it's my story, because I got very early age inside an incubator in Paris, because I was working for a startup that got incubated there, that was called The Family. And
what a great name, The Family. I love it. So cool.
But yeah, they are a little bit down now because the partner fight, but they were really, really great. We had Peter Thiel and all those great people at that time in early 2010 in Europe. Imagine coming to the incubator, so it was great. And
that's awesome.
I was getting classes for free because I was an employee inside of their portfolio company. And what happened is I started using the first investment I made was TransferWise. That is Wise now.
Wise,
but in 2015 it was TransferWise. And what happened is that I was looking for a solution to transfer some money to the US and start making my due diligence like a customer. Find TransferWise, and I was using before that. I forgot the name. A very well-known one, not TransUnion. What is the name?
Western Union.
Western Union. Sorry about that. I use Wise, and it was the interface.
So much better.
It was so much better. It was so much easier. It was so much cheaper. No problem. I mean, it was like blow-minded for me as a customer.
Yeah.
And so, because I was already inside and I was, exposed to that VC at early age, my brain was, okay, let's see where they are in their funding. What is the valuation? What is the team? What is, but because I was exposed to an early age, it allowed me to do that. And so start doing that. And then to respond to your question to the allocation, that's where the funny part is starting. I mean, first investment, small ticket, it's impossible to go in. So I discovered them in Series A, try to go in, of course. Sorry for my language, but they just closed the door.
Yeah, they were oversubscribed.
Yeah, I mean, they don't want you. I mean, I'm nobody.
That's right.
My ticket was not like millions of dollars.
They call it smart money.
Yeah,
they wanted smart money, strategic money. Yeah.
And so start working my way in. Start asking to the network who is already an investor, who is what fund invest. Try to make relationship.
Yep.
And so work my way in Series C, Series B. No, impossible. Okay. And Series C, take other co-investor to have a bigger, ticket and went in. And so that has been for the 5 first company we invested. It was the case. Every time it was the case. Canva, that now it's a 49x position for us.
Wow.
Was exactly the same scenario. I use them, and I'm not a designer at all, but I wanted to do some stuff. And
I do all my keynotes in Canva. It's awesome.
It's
brilliant.
Awesome. And so, Series A, no, there is no place for you. We don't know you. You are nobody. No thanks.
Yeah.
And then work Series B, same. And Series C, go in through relationship that you work. You work in. And it's funny because when I moved to the US and in 2019 we did the deal with Mercury. We did in Series A. We got accepted in Series A, but I was already in the market for like 5 years and working my way in and looking everywhere.
You're building relationships early.
Building relationship. That's how you get the allocation. There is no magic to that.
Right. You got to know people. Plain and simple.
After that, when you are Sequoia or A16Z and you work as a partner or whatsoever at that fund, is completely different game. But if you are an independent and don't have that big track record and stuff like that, now it's fun too. And because you know the deal that we work on, it's much easier. We have bigger ticket, more power. We are known. And we have the track records. So it's completely different game.
So I obviously know I cannot mention the company name or what's going on here, but when I told people in my community, in my circle of influence, 1, who you had access to, and 2, the amount that you had available, people were blown away. And it was like, wait a minute, how did he get access? We wanted this. This is incredible. So it's really just a testament to the way that you have built your reputation, to the networking that you've done. I certainly want to talk about that a little bit more because I bet we can get, more precise on how to build that and reputationally how to grow for other people that want to do that over time.
Yes.
But before you do it, it's nice to find the people like you that can do that on your behalf, right? I don't have these relationships, but for me as an LP, I'm able to get access to these things that I myself don't have access to, even though I've got a wide reach and I've got a lot of relationships. There are definitely some spaces I am not known very well in, or I haven't built the reputation or whatever it is that you need to do.
Yes.
Okay, but let's first go back in time. Okay. So you're from Belgium originally.
Yes, the French part of Belgium.
Yes, it's pretty fun actually because we had another PEF, post-exit founder at our event Wednesday night, also from Belgium, which is cool. We had a Finnish guy that was there as well. So it was nice kind of having that part of the world represented. But prior to being, so like you're an investor now, you're picking these awesome companies to invest in. Prior to this, you started a couple of companies. You were an active operator. You had 2 different exits.
Yes.
And I know one you're probably more at liberty to talk about than the other, but I'd love to have the audience understand a little bit about that, like what you did and how that transpired and what kind of led you to come to the other side of the table.
Yes, I think, and I was discussing with Connor about that. your Connor
Yes.
that work with
Connor
you.
Morita, he's awesome.
Yeah, and it's funny because we were talking about my story, and because I was more working for that family office, Saudi family office, making investment in Europe, and then moving to Miami and continue to invest before ever be an operator. And when I got the first exit, I become a CFO, and Connor told me, said, what was your studio? You become a CFO? And I said, I never studied that, and that's true. He said, but I don't understand how you got the job. And said, I think I'm a good seller. I'm a good pitcher. I'm good with number, of course, as an investor.
Yep.
So I learned how to be that. And so after that, I stayed in the company for 7 months because we negotiated an offer to a PE, and the PE, I was the one, because of my network, to bring that PE. So it was a great exit for me.
That's awesome.
But only 7 months. And then directly after that, funny story, I have a friend that has a cousin, working in Miami. He had a credit repair, business. I never heard about that in my life. B2C, a little bit of B2B. And he wanted to have a CEO that have this tech, oriented knowledge. And so he said, hey, come to work with me. I give you 15% of the company. And I said, listen, if I come to work with you, I want to be your partner. It's 50-50 or I'm not taking the deal.
Okay.
And
by the way, that's a big jump, 15 to 50, But
I was in the position to negotiate. I didn't need to work. If I don't want to work for 10 years, I don't want to work for 10 years.
Really
so I mean,
nice
and I can, go back to what I love, that is investing. So it doesn't matter.
And I tell people this all the time. It's the beauty of having more options in
leverage.
Life. You have a nice exit. You don't have to do anything. So it's got to be the right fit, the right people, the right culture. Just everything has to be right. And I always tell people, hold off till you find a perfect scenario for you, which it sounds like you did.
Yeah. And so I told him that, and 2 weeks after they say, you are crazy, I'm not giving you that. He was doing around 1 million at that time. And I said, okay, no problem. 2 weeks after that, I said, okay, I'm giving you the 50%. What is funny is when I checked the company, I had the same due diligence thinking with when I was an investor. So that was coming from my investor side.
Okay.
What I learned from everything I had done before. And so when I checked the company, he was doing that revenue without any automatization.
Yeah.
And that's why it get me excited, because
I
knew with what
totally
I knew,
do that.
with simple tools, I will completely, bring the company up. And that's what happened. I think in 6 months, we were at 4.8 million revenue.
Okay. That's great.
So completely growth the business. And what happened is that, and that's another true story and funny story, is that it was not coming at the office anymore. I was handling everything, and at the start it was really a 50-50, so I was not happy, and I knew the relationship will not continue on the long term, so I wanted to exit. So I was ready to sell my share. And so I went to the office that day, and he come to the office and he said to me, hey Yotis, I like you, I want to keep you as friend, but I think we should, separate ourselves.
Perfect.
But it changed everything, because the number I had, I did 5x on the number, because it's different if you want to sell your part to him, because we had an agreement on that, or if him ask you to buy you out.
Yep.
And so that day, I was pretty happy when he said me that. I was inside of me. I was saying, oh yeah.
That's cool.
So we negotiate, do a buyout with the revenue of the company, and I was out. But what I understand is, I am not able to focus on one project more than 6 to 7 months. I like different industry, to feel like excited. That's my personality. And so, going back to investor as a VC, it's what you get, because I'm getting, every industry, I'm getting like 15 deck a day. So I'm learning is different. Every day is different, you know? And so that's why it keep me excited.
Well, it's great because you're building the skill set along the way as an entrepreneur for what it's going to be like, once you are officially an investor. And for most entrepreneurs, they are horrible investors. I mean, I speak to entrepreneurs all the time because it's a different mindset. There's skills that are learned. Very few people transition from entrepreneur to investor very well without losing a good deal of money first, or at least learning the habits. It seems like you really did. You may have been more predisposed to some of the details and being an investor, even as an operator, though.
I think it was because of my story. So I was first, employee's assistant. I was the assistant of a CEO and co-founder of a startup in Belgium. And so the guy was, much older, but already had, a couple of exits before. Mm-hmm. And I learned so much just to be with him in the room because I was his assistant. So I was exposed to everything as an operator.
Yeah.
Already at that time. And then I go inside the family, the incubator. So I was exposed because the incubator, they were taking like 3% at that time. So I was exposed to that. I was exposed to the investment. And then we received an offer from a Saudi family office. And founder refused the offer at the end. But the director wanted, access to the family because he had a mandate where he was investing in pre-seed and seed in Europe. That was the mandate, okay? And he told me, he said, you are all the time in the family. You have all that deal flow. And at that time, it was the best deal flow in Europe, to be honest with you. Come work with us. You can keep your job, but come work with us as a scout. You stay here. We don't need you anywhere. You stay here. And you just, this is our investment thesis. This is what you need to do. And that's what I learned. That was my second job was that. It was what I'm doing today.
Right.
But it was 12
way
years
back
ago.
When. Yeah.
So that's how I learned all those, by first working with them and
that's
then
awesome.
move to Miami, continue to invest with my own money and also with co-investor. Cool. And that's all the story. I just, teach myself deal by deal. Yeah.
Well, let's, one of the things that I want to talk about with you, because I think you guys are really pioneering a new model in the venture space. So I've got a big complaint that I try to voice quite regularly, and that is that I feel most people that are raising money or managing money have misaligned incentives from the people that are their clients, or their investors. And so it bothers me so much seeing people making money when the investors are losing money.
Yep.
And so even in like PE venture, it's I feel like for too long, it's kind of just been this 2 and 20. And now you're seeing I saw some deals to get into SpaceX, like 5 and 30, like crazy numbers, right? And so as I quote that, for those of you that are unfamiliar, it's like 5% admin fee or 5% fees and, 30% carry. 2 and 20 is pretty standard, but there are ways to structure it that are in much better alignment to your investors. And I feel like you guys are doing this the right way.
Yes.
I'd love to hear your thoughts, number one, on why you're doing it, because you don't have to. Industry standard could allow you to just keep doing this. But then number two, there has to be like a reason. Like I've got to imagine you've experienced something traumatic or something that allowed you to recognize the value of being in such alignment with your investors.
Yeah, I think there is two story. I think there is an inner story that I never share, I think, to anyone. The first story is that my father was, at some day was an investor. So he invests with someone that was a manager, and at the end of the day, the manager, didn't work well with the money. So he lost all his investment.
That's brutal.
And I think when I was younger, and I know that, it was really painful as a young kid. And so I think that marked me inside me, and I said, you know what? I want that any LP needs to live that. anymore. It cannot happen. You know, you need to be very transparent. And so to respond to your second question about what is going on, I think the market is broken, is really broken on the fee, because it has not been performing for the past 6 to 7 years. Even now you have SpaceX, and that is going to give liquidity. But after that, the LP start looking and say, okay, I'm giving you 2% for what? For return of 1.3% on my money. I mean, it doesn't make any sense. And I'm going to give you a story, and might have some enemies after that. So, but that's live and that's true, so I can share it. I know someone that just raised a 600 million fund. And so, of course, he's doing the 220. Yeah. He has a couple of partners and analysts and whatsoever, so he has a team with him. But I know he paid them really, really bad. And so there is 12 million every year.
That's a lot.
It's a lot of money.
By the way, where's the incentive now to perform if you're making that kind of money? This is my big, issue.
I have a question for you. Let's exchange role. How much is paying himself yearly?
Well, I mean, he's paying his team. No, I mean, he's not paying his team even 2 million. So he's probably clearing 10 himself, 10.5.
You're good. Is taking 10 million every year on the, I mean, come on. I mean, you cannot pay yourself 10 million and then be focused on, the performance for your LP. It's impossible.
Right.
You need to have an incentive. Okay?
That's right.
And so that's why also I know it just do a deal to just make a little bit over 1.5 in return and already raise for another fund.
Right.
And that's
this is common. This is what is going in the market. This is industry standard.
Yes.
It's like, so, now we're raising the next fund so we can get some more fees.
Exactly.
And by the way, if you're making this much up front, and this is so when I talk to people, even this is in real estate, this is in private credit, this is in any other space, PE, if you are making all these fees on the front end, you're actually disincentivized to see things to the end. I actually want people to not make much until the end and realize, like, you actually have to be a good performer. You make your money at the end so that you are a steward of my money for the full life of the fund.
Yeah, I think it's not about the 2% that is the problem, and all the LP I'm talking about is not the 2%, because they understand that they need employees, they need to have money to run the fund. What we have done with YXS Capital on the fund too is that every money that we receive from LP, first we return 100%, and then all the management fee that we ever receive, we return it to the LP as well.
Oh, I love that.
But after our LP make 3x net, so not gross, net back in their pocket, we get an incentive. What is the incentive? After that, we're getting 30% carry. It's just showing our LP, and it works pretty well with family office and wealth manager that we work with, that we are there for the big commission. Right. And don't get me wrong, I'm here to make money. You know what I mean? I'm transparent with that. But I will make money, and even more money, with my LP. When the LP they have their money in their pocket. It's funny because there is some fund that use the American waterfall. Do you know that?
Which is brutal.
Oh my God.
It's the worst structure. By the way, you're from Europe, so of course you're going to prefer the European waterfall. But
no, of course.
It's not even anything to do with countries. Like, the European waterfall is brilliant because that's how you should invest, right?
Yeah,
because
of course.
You make your money first, right? Which is really important.
All the LP needs to get their money first before the GP can get any carry.
So actually, let's have you break each down just so people understand this.
Yes. So European waterfall is when we need to give back all the principal of the LP back before calculating the carry. Us, in our position, in addition to that, we reimburse, we send back the management fee, and then so it's a ultra American waterfall. Let's call that like that.
So it's European friendly. I just want to say, so European waterfall, super LP friendly.
Exactly. American waterfall is deal by deal. So let's say you invest in a fund, the fund do an exit, a nice exit. They are going to calculate a pro rata to send back to the LP, and then directly, make carry on that deal. The problem, and the industry, they don't work like us on on quality, more on quantity. So
Yes.
there is a lot of deal where you lose your money.
Yeah.
On those deals, nothing happened. So that's mean is really not LP friendly
That's
at
right.
all. It's the opposite, because managers are getting money and bonus on good deal, but they don't have any return for a bad investment they are making, any consequences.
Yeah.
And so that's already a misalignment when you have that structure.
So you got a misalignment first with, the fees typically. And then secondly, now the waterfall is lopsided to the sponsor. So now, do you think the sponsor in an American waterfall that just had a big exit with one of their companies is actually as incentivized as before to see things through to the end? No, they've just made a windfall of cash.
Yeah.
So I love your model and the way that you guys are doing it. I think that that's really smart to be in alignment. And by the way, of all the funds I've looked at, I look at a ton of funds. I've done a ton of due diligence across the board. There are only 2 funds that I've ever come across that are doing what you're doing, that have this model. By the way, there are probably some others out there, but I'm talking about like thousands of funds I've found 2.
I think it's going to be more and more, to be honest with you. I think that's where, if you want to raise and make, LP happy and respect your LP, I think it's going to go that way. Let's face it, maybe in 5-10 years, but it's going to go that way. It's the same with liquidity. Before it was 10 years with 2 years addition. So during 12 years, sometimes you don't see your money back.
That's right.
And that's where it's bad also for the management fee, because you're paying the management fee during 10 or 12 years.
That's right.
So imagine the money you're losing because they don't reimburse that.
That's
in
right.
This, classic structure. And so what we do...
You haven't gotten your money back that long because the fund's not going well.
Yeah.
So not only is there not much on the carry side for you, you're paying out the fees.
And that's why the industry is broken. That's why, a lot of LP are going to the big fund that can, have great performance instead of, have more, medium and small fund. But what you need to do in the industry right now is this 10-12 is going to change as well, because you have the secondary, and we can talk about that secondary market.
We should. Let's talk about that
more.
next.
But now you need to be at 6-7 years, length of the fund with a 2-year additional. But that will, for me, be the norm, and that's what we're pushing to as well with YXS.
Yeah.
So less fee, more on the performance, and quicker to liquidity. Of course, because of the secondary market, we can do that now. That 5 to 10 years before, it was impossible.
Well, and for me as an investor, I like that, because you're saying, hey, I'm so good that I can make my money on the deals we're doing, right? Like I can send you back your original principal. We're sending you back the fees. Like we're good enough that we can make money, in what we're doing. Like I like that confidence as an LP. Super important.
I think it's not, and I don't like to say I'm too good and stuff like that. That's not true. I think we have an investment thesis that really allow us to do that, because we de-risk a maximum the investment. And so when you invest in Series B on our industry tech of, market that are really booming, like AI, robotic, military tech, space tech, that, if you doing the right due diligence and investing on the right company, 12 months after that, you are already going to double your money, because another raise is going to happen. And then you're going to the secondary market to get liquidity if you need to go to get liquidity. That's where all the strategy changed. That before you needed to wait IPO or a full buyout or merger. And even merger, sometimes you don't get, any cash. It's more, new equity on a new business. So it changed everything. And so totally that's why we don't touch, pre-seed and seed, because it doesn't make sense with our strategy.
Even though likely in time, secondaries will touch that space too. But let's talk about them, because we went through an IPO drought. So not only was that one of the only ways to have an exit, it was basically non-existent for the last couple of years, right? Anyone that didn't do well. There weren't very many of them. It was very much of a drought. So now it's good seeing that, SpaceX had a successful IPO. You've got a bunch of others that are, coming along, right?
We think 2027.
Yeah, 2027 is going to be
that's the year for
pretty exciting time. And
every investor in SpaceX.
Yeah, it's incredible. And for like our mastermind, a ton of us invested in, XAI, SpaceX, OpenAI, Anthropic. There's a Kraken. There's a ton of them that are, going to go public, which, is super fun. And, it's neat seeing our members having that opportunity. But secondaries are like a game changer for the industry. So if you can expand, so for me as an investor, I love secondaries. There's a lot of reasons I like secondaries. I like that you can see, because these are companies that are further along, so you actually know how they're doing. A lot of them are profitable.
Yes.
You can sometimes you're getting employee shares, you're getting them at a discount.
Yes.
There's just so many things to like about it. But I'd love to hear you unpack how secondaries have kind of unlocked capital. They've provided exits, and then they've provided the people that are exiting with capital that might be really needed. A lot of times it's employees that, they're in it, day one or
yes.
early days. So it's like they had a huge windfall. They could use the money right now, and then you come in at a discount.
Yes. And I think secondary is like, the public market, but with a little bit of more time if you want really value on your investment. But like you said, it changed everything for a lot of people because it gave liquidity to private, company at almost from, I would say now, series A or B to C, D, E. And so that changed everything as a manager, again, depending of, let's say you are a pre-seed investor, even a fund, and you're going to Series B. If you invest well, a Series B is going to give you minimum a 20-25x, really minimum of your investment. Depending of what your LP are looking for or your performance, it's great to go out.
Yeah.
At the end, if you are not needed to do 100x, it's a great opportunity to get in the track records, to get DPI, to give back to the LP, and just play the long term. So it changed.
And you don't have to sell all of it.
No.
You can just take some chips off the table,
course.
Right?
And there is a lot of employees doing that.
Yep.
It's funny because we are on the deal. I cannot say the name. It's another deal that big company in
Just who we talked about this morning?
No, it's another one.
Okay.
It's another one.
Because I was excited about that one too.
Yeah. I cannot say that. I'm going to give an info. It's the competitor of Waymo. Okay, based in Europe. If I don't say the name, a lot of people will know which company
I know what you're
talking about. So, great opportunity. So it's a funny story. Is that this opportunity, again, about the allocation and getting the allocation, I got the deal from someone that I know for 10 years in back to the family, where everything started for me.
That's so cool.
And so now, full circle now is, a big guy, one of the biggest and the best in secondary in Europe. And so, he called me, say, I have something for you that crazy good. And it's employees selling share to the market, to the secondary market. And a great valuation. I think based on the last round, we are getting 20% discount. So awesome opportunity, again, showing the secondary market. Employees getting liquidity from guys like us that want to invest in Series B, but I don't have a problem to all that and sell in Series C, depending of the return I'm going to make, of course, on the time and the X I'm going to make on the investment. But again, we can do that, and I'm talking personally with YXS because we're looking to do 5X on the 2 to 3 years holding. And so all my investment in my head and decision I'm making is based on that.
Yeah. Can we do this? If not, it's no.
No losing money and 5X in 2 or 3 years holding. That's what.
Hopefully it's greater, but it's like 5X is your number.
Yeah, because after that you cannot control. Let's say, let's face it. When you invest in a company, you know the potential, but you cannot predict like 10, 15, 20X. If someone telling that is a liar. Sorry to say that.
Now, here's an interesting thing that I'd love to touch on. Because I have heard some horror stories, and luckily this has never happened to me. But I've heard some horror stories of people trying to buy secondaries on their own, or secondaries that haven't been perfected.
I know what you're talking about.
Even the counterparty risk that exists if an employee changes their mind because the company goes back up.
Hashtag Anthropic.
Yeah. So there's tons of risk, in this, if not done correctly. If you do it correctly, all works great. If you have a path directly on the cap table, I think that makes sense. But can you explain how to do it the correct way versus what the risks are that people should be careful of?
Yeah, the simplest way is the what happened with Anthropic. Cutting all this multiple layer of SPV. I think secondary is great, but now needs to in every new industry needs to have a some down problem to make some rules. I think to make it the more simple is when you invest in SPV, make sure that the share is held inside the SPV you are making the investment.
Mm-hmm.
There is no more simple than that. You cannot invest in an SPV that have the right to buy the share. For example, if you have that with employees of Anthropic, and that happened because I know from a couple of LP that we have that are in this situation. After that, the employees they say, hey, I don't want to sell. I don't want to sell anymore because in 6 months I just 15x my position. And in addition, the company say anyway we didn't sign for the transfer.
Right.
That's it. You cannot do anything. So it's you need to be careful on that. But the best way, make sure that they have the transfer or they have the share inside the SPV you are making your money. You are investing your money, sorry.
Yeah, that's good. So I just, as much as I love secondaries, I just want to say, beware. You got to do it the right way. I think that's super important. Something else I want to talk about. You've invested all over the world. You've invested in Belgium. You've invested in France. You've invested in a number of other countries. I mean, we can talk.
Not Asia.
Asia.
Never Asia.
But all over Europe. You've invested here in the U.S. So if you were to say, hey, right now I'm most bullish, are you most bullish on U.S. companies? Mm-hmm. Is it European companies, or is it still a little bit of both? Because I know the success you had in your first fund was very heavy, if not all, U.S. companies, right?
It was a mix. If you depend, what is the calculation you want? Are you calculating on the result, on the cash result of the performance, or on our own investment? So that's two different things.
That's good. Yeah.
On the two, it depends also because we have Canva, and Canva it's an Australian-based company, but now they have Delaware, and we invest when they were in Delaware. So let's count as an American company. We are, I would say, 80-20 on the performance. From Fund 1, we are going to be around that. I think we're going to be 85 US, and then 5-10 Europe, and a little bit over, because I don't like to really close my mind to geography. We don't look Asia because I don't have any contact. Mm-hmm. Really nobody. I don't have experience. So we are not touching Asia, but in Dubai, there is a couple of deals that I've seen, and I went, last time to Dubai. I was impressed by the quality. Of course, Europe's still good. Israel is good too. Israeli company is good.
Yeah, you've done some. And by the way, on the tech side,
on the tech side, and and after that you have the US, but that will be, what we are looking for.
Now, let me ask you this, and you may not have connections in Africa, but you had said fintech is one of the niches that you like, and Africa is kind of, a lot of countries over there that are really taking form, and Latin America on the fintech side of things. I know you invest in Latin America.
Yeah, so Latin America is great. It's a great market, more mature. Africa, I have a friend that talked to me about it, and I've seen deal. Honestly, again, I don't have any experience. And the deal we are making right now, it's great deal where we have control, we have relationship everywhere on those deals. So I'm not going to look Africa. I think there is a big opportunity. Don't get me wrong, but that's not a market that really excites me. I think it's more risky. You need to keep in mind that I like to say that I'm in ventures, but I'm not a big risk taker.
Right. I like that.
It's you know, it's funny. It's, you know, my partner Sunny Patel, that was an investment banker for many years, you know, is telling, and that's true. We are really, you know, in venture, but with, you know, the P mentality, investment banker mentality, even on the due diligence.
Boundaries.
That's really what define us, you know.
That's right. All bankers have pretty hard boundaries on the safety side of things, right? More of a conservative approach by nature. Make your money, figure that out, right? But I like that. It's like a PE mindset in the venture space with a unique structure that's LP friendly.
Exactly.
But then in specific lanes where you have the relationships and you feel like the returns could kind of be outlier type of returns.
I think for Fund 2, I'm going to be honest with you. I have you know, when we make our investment, I'm really, you know, focused on the 5x return, on the growth, let's say growth 5x. I think, you know, first fund we did 14x, and that's incredible. Of course, there is part of luck, but you need to, you know, provocate. When you say that in English?
Yeah. Provoke. Yeah.
Okay. Provoke luck. And so inside of me, I have a number that I want to reach for Fund 2. But based on also now the value add, because we have value add with YXS and the team, you know, the first one is really on the Fortune 500, you know, commercialization of every company we invest in. Okay. So every company we invest in, before investing, we have a rules that we need to add value from day one.
Okay.
So that's another rules that we have before investing. If we cannot find, you know, provide value, of course, in addition to money, we don't make the deal. Okay. Yep. So that's one. Fortune 500. We are inside NVIDIA VC Alliance with Fund 2. Okay. So great partnership with NVIDIA.
That's awesome.
We close to Pfizer. We close to Verizon at an executive level. So we have this real network that we leverage for our portfolio company. And then we are B2G. So B2G connected to the American, you know, government, but also government in Europe and the GCC. Sorry. So that's really our true value add when we are looking to do a deal and making a deal.
Yeah, huge fan of B2G. That's been a very good segment for me personally.
Of course.
And especially, you know, in you know, anything that I mean, I love government contracts. You know, and I also love when governments invest in companies in the form of a grant, so it doesn't dilute the investors, right? So you see a lot of that, which is pretty cool. But you know, some of my other favorite investments, you know, in that space are you know, like the big boys, like Saronic and Anduril, and I mean, just some of these companies are doing, and there's a handful of others of them that are doing amazing things. So there's a group based out of here that Scout Ventures. I don't know if you're familiar with them. I think they're doing some awesome stuff. I'm friends with the founder.
Venture? Yeah, I heard about them.
And they have some pretty awesome relationships, and so
well, B2G is even more relationship than everything else.
That's right. That's right. So let's say that you were getting started, you're brand new, you're not this awesome fund manager, but we've got people here watching and listening that are like, hey, I want to figure out what my next step is in building wealth.
Okay.
What are the niches and sectors that you are most excited about or would be most excited about? I imagine there's some overlap, obviously, with what you're investing in. Maybe there's some things that you're like, hey, I love this space. Maybe we're not investing in it yet. So I'm curious, like, what would you do? Like, you lost all, let's just say that you're starting from scratch. You've got no money and you want to go and, you know, find a niche or a couple of niches.
So if I, you know, I lost all my money, that's mean I want to be an operator, correct?
Yep.
That's the case.
Yep.
That's a user. Okay. On the operator.
Actually, let's do both, operator and then investor. So,
but if you have no money,
so right now we'll talk operator.
But even with no money, if you still have the contact and stuff like that, there is a way. Okay. So no money on the operating side. I know it is going to sound like, you know, easy response, but you need to leverage AI, and you need to go to AI. I think there is way to, you know, find a co-founder that is really, you know, tech oriented on the AI, and respond to a problem. Honestly, for the past 15 years, I think if you have no money and start a company, it has been exactly the same structure and the same finding a good tech co-founder depending of also your profile.
Right.
If you are the tech, you need a CEO that can pitch and do the business. Honestly, that for me, every time we look to a deal, it's really the best team or that one. And then, leverage what is on the market and responding to a problem. That will be on the operator side. On the investor side, if I don't have money, I will, start from zero and go to, YC, go to free event in the tech industry and just get relationship. And with those relationship, negotiate some, company saying, hey, I'm looking to make some investor, or even, lying and saying that you have investor, somewhere that looking to make deal. Sometimes you need to do that. Can you share me some deck, and getting some deck and just checking, what is really unique company and try to level up on the deal flow, get that deal flow. And then with that deal flow, start building your network of investor that looking to that, but don't have your expertise or, doing something else, like a lot of, people that, and make sure that you propose good deal, and take a carry on that. That the truth with Fund One is that the first couple of deals that we did, it was no management fee, 0.
Wow.
Because it was co-investment and structure by structure. And the first deal I was taking 5% carry.
Wow.
Because I didn't have, much money and I wanted to have a bigger, ticket.
Yeah.
So why you will put your money with me?
Yeah.
I need to convince you.
That's right.
And show. So I cannot ask, 220. So I started with 5% and then 10% and then 20%.
Wow.
So yeah.
That's awesome.
Yeah.
But I also love that because it's like, hey, I'm willing to do less than market rates. And I'm willing to earn your trust, right? And I'm like, and it's also like, I'm going to prove to myself that I have the chops to charge market rates,
exactly.
So I love that. One last thing I want to talk about here, and we've talked a little bit about it, but identifying great companies isn't the hardest part. Getting a seat at the table, having the relationships that can allow you to get in, that's the hardest part. And so whether someone's investing in startups or real estate, private businesses, private credit, whatever it is, what lessons can they learn about building trust and really becoming the kind of investor that people want on the cap table?
I think it's like, the young kids looking to Instagram and want to be rich in 2 days.
Mm-hmm.
It's exactly the same situation. You need to play the long term.
Yeah.
You need to play the long vision. You need to have, your own ethics saying, I am going to look, to a deal that I'm sure at 100% is going to make money.
Yep.
Because on the long run, those investors are going to go back to me and, and work with you. By the way, I think I told you the story that is a great example with one of our, fund LP, where I knew him and shared deals and invest with me in the past. And he told me, when you're doing Fund 2, that we wanted to do Fund 2 more institutional, one, bigger fund.
Yep.
He said, come back to me and I will invest in your fund. So I went back to him and say, hey, we're ready. That's, we want to do a 100 million fund. Will you invest, in my fund? And he said, listen, I know I told you that I would, but I cannot. And I said, why? Because I will need you to double the size, because I don't want to be the only LP and I'm going to put 100 million.
Wow.
But again, I mean, I knew the guys for so many years, and, he knew that the deal we were making together before. And so it was really important. And then we did that in his LP in a fund, and we increased our capacity. But it's just show you that you need to gain the trust and you need the long term. Even if you can make money on a shitty deal, don't do it.
Right.
Don't do it, because after that, with investor and LP, you have one chance.
Yeah.
If you don't make them money,
that's right.
They're not going
back.
to invest,
Nope.
and you are going to hurt your reputation.
That's right. Yeah, you hurt your reputation, it becomes infinitely more challenging, if not impossible, to raise on future funds.
Yeah.
But I love that problem that you had, where it was like your fund is too small. I want to put in 100 million. Your fund is too small. You got to increase
I'm
capacity.
not the only one. Honestly, I've heard that story before from other GP, and yeah, I'm not the only one that happened. That happened.
And I know you've got an investor that put in even more than that, which is awesome. So it's got to be cool for you to, it's like, when I first started investing, it was like 10,000 or 25,000 or 100,000 or, whatever the number was. And it kept going up, 250,000, a million, like whatever, as my income grew, my minimum investment grew.
Yep.
You on the, fund side, I would imagine your smallest check is like 250 in the early days, and maybe you're going up to, million, 5 million. It's got to be really cool to get 100 million in one lump sum, 200 million, and really start connecting with a lot of these family offices, institutional investors that are coming in.
I mean, it's exciting for sure, but I think it's more responsibility as well.
For sure.
Because that's
a lot of pressure on you, doesn't it?
It's a lot of pressure. It's a lot of money. So that you have one chance. Again, it's the same after that. It doesn't change that much. It's more exciting because of course it's a big number. So but after that, honestly, the process and the pressure, it's the same. It's even sometimes less. Because those kind of big wealth manager or RIA, they have so many investment, they are managing billions. They are not going to be on top of you.
Right.
That more strategic investor, that's a lot, even if it's smaller check, and I don't like to say that it's different check, but they are there. You need to show them what you do, and you need to deliver. But I mean it's more like you are more like proud on the fact that you can see where you start and where you are going, and the kind of which room now you can enter, in which table you are, and you are respected, and you convince people, an individual like that to trust you.
You earn it. That's what happens. You have to earn it.
It's more like it's more that pleasure.
But building the trust and building a relationship and delivering previously to help build that, which is awesome. Well, it's been a pleasure getting to know you and Sonny and Lauren, and I'm just so excited for all the cool things you're up to. I'm excited that you're going to be coming into town more often.
Yes.
Where can people learn more about you, Yotis, and YXS Capital?
I'm on LinkedIn. I think that's the only social media I'm using. So I'm in LinkedIn, Yotis Tonnelier. Our website, we have a LinkedIn page too, and that's where they can reach out to us. We have an email. I'm not going to give my direct email on the podcast, fine. But we have a pitch at YXS Capital.com for deck. But you can even send another emails. We see everything. I'm seeing everything. So Well,
it's fun when you get to a point where you don't have to raise money, right? That the funds just keep populating themselves with previous investors, and the check sizes get bigger and bigger.
We're still raising money to be transparent.
Okay. Very good. Very good.
Fund 2 is not complete yet, but yeah, I would love to. That's funny. That's a story I'm saying. If we return on the size of our fund right now, if we return 5x to our investor, I will not need to take my phone anymore for the next fund, and that's the goal.
Cool.
Is because after that is honestly I'm it's really exciting too, because you meet so many people in person. You have the time to travel, finding LP. You create those relationships, and so there is, it's not sexy to fundraising, and the same for funder. It's funny because funder and GP, same world, same. It's not cool. But at the end, when you finished, you said, okay, I meet so much, person, travel, and it give you some experience.
Yeah. What's the size of this fund going to end at?
We are not sure.
Okay.
That's something we are not sure yet, because in fundraising, you have commitment and even signed commitment. But what I like to say, and I said that to all the founder, and I'm pretty sure founder that have raised fund will share my thinking, is that until the money is in the bank, you didn't raise anything, my friend.
That's right.
So let's see.
Great way of doing it.
Yeah, let's see. But honestly, with you, we can stop now, and we'll be good to go. And
well, I appreciate that you're raising more, if it makes sense, but I love that you are at a point where you didn't.
It makes sense because of our deal flow and the
you're getting
allocation.
More access. Yeah.
And so the deal is really good. And so I will never raise to raise. It doesn't make sense. Again, why? We give back the management fee. I don't have any interest to raise for raising.
Right.
My interest is only if I have the great deal and I'm going to deliver performance, because that's where my incentive is.
That's right.
That changed everything.
Which, by the way, for those of you investing, find the alignment where you're finding people that have an incentive in the performance, not in the fees, but in the performance. Awesome. Well, thank you so much for flying in, joining me here on this. And this has been a blast. I love ending every episode with a question for our audience. So if you're watching this or if you're listening to this, what is one step you can take today to move towards financial freedom and really just move towards living a life that you desire on your terms? So not a life by default like most people, but a life by design. Thanks so much, and we'll catch you next week.
Thank you.